validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we're talking about this, that, and everything in between. Today, Saturday, we've got a little bit of stuff going on. We're going to be talking about insurance tips, and we're going to be talking about life insurance coverage as well, and comparing that to the average stock market. So for those of you, I see y'all watching us on Twitch as well as Twitter. Special shout out to those of you that are watching us from Twitch. Well, that's the Twitter link right there. And then for those of you that are watching us on Twitter, there's the other link right there. So if you guys are interested in commenting on the show and y'all want to do it in real time, you can always click that link, approve the mic, approve the camera. It brings you on in real time. And then we will be able to have a face-to-face. Now, for the rest of you guys that are interested in just throwing your comments in the comment section, this is an interactive podcast. So Twitch, Twitter, if you guys throw comments in the comment section, you will, if they are appropriate comments, see those comments, especially if they're in line with the topic in the comments that come up on the top of the screen. We are live 7 nights a week. For those of you who don't know, we start around about the same time. We do not let the sun rise without going live. So even if we're a little bit late and you're looking forward to the show, hang out. It will go live at some point. The goal is to start about 45 minutes ago, but typically we start about 20 minutes ago and we make it work. from there forward. With a 4-minute intro, 4-minute outro, you guys can enjoy that. Comments during the intro goes up onto the show. Comments during the outro also goes up there as well, as long as they're appropriate. We have a different topic every night of the week. Tomorrow, Sunday, we have questions and comments from the fans. We're going to be trying that 16:9 with some of the new features from StreamYard, see what that looks like. And then we're going to switch back over to the 9:16, talk about that dome that Trump is talking about building and how that's going to impact our ability to travel in and out of the country. We're going to be talking about different financial strategies on Tuesday, because Monday, Tuesday, and Wednesday, we talk about how to make money, spend money, invest money, and live more affordably. Since this is a podcast that is 75% male podcast, male driven from the male's perspective, we typically find places where men can find better places to live and invest, where they can find that traditional woman that is different from the westernized women that we more often experience. We help you guys Monday, Tuesday, and Wednesday with financial decisions that helps you guys with making yourselves higher value men to increase your probability of finding a woman of more value. Now, Thursday, Friday, and Saturday. Today's Saturday. We are talking about everything else under the sun, including personal development, first-person accountability. Today, we're talking about health insurance. We're talking about all kinds of insurances, specifically because when you have insurance coverage on yourself, you typically want to get that as a fallback in case something bad happens. You have different types of policies. You have insurance policies on your property, your stuff, warranty kind of things in case things go bad. But then you also have policies on yourself, like healthcare, and to take care of yourself and the people that you care about, and health insurance policies, so that if something happens to you, that you can link for somebody else. The other thing that we have is the idea that if we are a beneficiary of a policy, say you get an insurance policy for your wife or your husband, or if you get a policy for your parents, how would that positively or negatively impact you as far as your monthly premiums versus the expected payout? So we're going to be covering all of that stuff today. Make sure that you guys like and subscribe, share this information to somebody that you know that needs to know this information, somebody that you know that can argue against it, because I take all challengers, because this is a research-based podcast where I went and did the digging to find the information that you needed to get on top of your topic. You got any questions? Please put your questions into the comments. I'll do the best that I can to answer them. And if you ever find a way to stump me on a question that I don't know related to today's topic, which does not happen so far, I guarantee you that I'll make a whole nother show about that question just to explain the ins and outs of whatever it was I didn't know before. Because since I do research 365 days a year, I'm learning something new every day of the week, and I make sure that I share that information with y'all. So with that being said, I want to welcome you guys to the show. Everybody, Twitch, Twitter, and YouTube. Today, we're diving into the topic that could literally change your financial future depending on what you do. We're going to be dealing with annual insurance reviews, but we're not stopping there. Like I told you guys, we'll break down how to pick the right policies in 2025. We're going to share the latest statistics as of May of 2025, and even compare what you spend in insurance with what you could have earned if you invested that money in the stock market. Plus, I want to hear your stories and questions live. So let's get ready to jump in. Why annual insurance reviews matter, and why should you care? Let's start with a quick poll. For anybody who's willing to comment on live, how many of you have reviewed your insurance policies in the last year? And what I mean by reviewing your insurance policy, have you checked what you're paying for versus what you're using? Do you just accept the monthly payments that they give you, or do you go back and review the coverage and determine what you're willing to use, or what you know that you're not going to use, and make adjustments to your policy to make that work? If you do check your policy, and you should check your policy every 6 months, but if you check your policy once a year, hit yes and throw that into the comment section. I want to see how many of you guys actually check your insurance premiums and make sure that you're getting the best price for the services that you use. Shoot, I check mine every month. Because you got some insurance policies, they give you a 30-day notice that next month your premiums is going up because of the average crash rate in your zip code. Now, that is the strawberry banana smoothie that we had gotten from Fit Chef Recipes. I had put one of the Fit Chef recipes up onto the show yesterday. So if you guys got time after the show, swing over there and go look for it. That bacon chicken wrap enchilada. You can see it on the screen, so on the photo. So you hit that thumbnail and it'll take you to the preparation of the food so you can see what we had whipped up a couple weeks ago. We're supposed to be working into some other things, so stay tuned for some of those extra episodes from the Fit Chef menu. And I'm doing things in a creative way, so I'm taking like 3 or 4 different recipes and putting them together to make one, but it's still very affordable because I spent about $200 on groceries for the whole month, which is very cheap. Now, life moves fast. New jobs, marriage, and new babies, moving to a new city, or even just getting a new car. Every one of those moments can completely change your insurance needs. If your coverage doesn't keep up, you could be left exposed, like what happened when Kobe Bryant's helicopter crashed and his infant was on the plane and the baby died along with him. And they had not taken the time, because the baby was less than 6 months old, to update the policy to include the infant on the policy. Situations like that can occur because you're not proactive about updating your information. You get used to things being a certain way and then you just coast. And then when changes are made in your life, but you don't change your policies to reflect those changes, you leave yourself exposed or paying for things that you don't need. So either you have something that doesn't have coverage on it because you didn't update your information, or you're paying for coverage that you don't need because you no longer utilize those services. So let's break it down. Catch gaps and overlaps. Bought a new car, added a family member, paid off your mortgage. Your coverage should reflect those changes. You'll discover savings. Insurers roll out new discounts all the time. Good driving, home security, bundling policies are all things that you might be missing out on. Avoid surprises. Policy term premiums and coverage limits can change every year and sometimes every quarter or every period. So whenever you have a new rollover on your policy, you might find that your deductibles are higher, or your monthly payments are higher, your down payments are higher, and then in comparison to what you was paying before, you're paying even more, even though you're supposed to be a loyalty member that has had, long-term exposure on the policy. You're still paying through the nose for something that you're, not knowing what's going on. And typically the person that you're talking to will give you a reasonable excuse that's not actually validating the situation, but it's it's across the market because of, higher claim rates. Usually what you hear. They just feed you nonsense, but you really have to do digging to find out what's going on. Reviewing your policy keeps you in the know and in control. So for anybody that's watching, has anyone ever here been surprised by a change in their policy? Like right before you got ready to put your card on file, they just started talking about how you had to pay more money. Share your story in the chat, or request to come on the mic. Let me know, and I will give you guys the link again if you don't see the link in the comment section, and I'll put you guys on, give you a link so you can get on and you can tell us a story yourself. Now, how to review your insurance like a pro. Let's make this interactive. Grab your phone and set a reoccurring reminder right now. Maybe your birthday month, or start the year at the start of the year. Doesn't matter where it is. It could be when your cycle is about to renew itself or something to that effect. Once you've done that, then you can move on. Now, here's going to be your annual checklist. You want to gather your policies, healthcare, auto, life, renters insurance, homeowners insurance, and any specialty insurances that you have. Safe Light for old cars, warranty packages, anything to that effect. And then ask yourself, has anything major changed in my life? Are my coverage limits still appropriate? Because sometimes you could need more coverage. Sometimes you'd be okay with less coverage. Am I paying for extras I don't need? Are there new discounts or better rates available? Because you can call your company before your policy renews and find out if they're offering any better rates for your current premiums. Shop around if your current provider isn't offering you what you're looking for. Even if you love your insurer, get quotes from others because you might save hundreds or more. And if you can get quotes from others, that shows that the same type of policy that you have with your current insurer is more affordable with another insurer, you might be able to talk your current insurer into reducing your rates to match prices with their competitors just to keep you from changing over, which is fantastic because then you can still maintain your current insurer and you can also maintain lower rates. Consult with an expert. If you're unsure, talk to an independent agent or a financial advisor. Rich people have a bunch of those. They do charge you by the consultation, but you can get the information that you need to make things work for you. And anything that you're doing with a specialist, if you claim it on your LLC, is a tax deduction. So, if you've been following the show, creating LLCs, C corporations, running all your money through those tax identification numbers, and then claiming all of the money that you spend against those tax identification numbers to offset the profits that were made on those tax identification numbers, you will come to find out that you're going to have a lot more tax deductions off of the money that you actually have to spend to live, which means that you owe Uncle Sam less money. Or in 2025, you owe Elon Musk less money since he's the one that's counting the money. Think about this. So for those of you that are on Twitter X, yeah, he counting your money this year. Now, they can help you spot opportunities and avoid pitfalls. How many of you have ever negotiated your insurance rate? Type yes if you have, no if you have not. Now, one of the things I want to do real quick while everybody's thinking about what they're going to do is bust some common insurance myths. And then we're going to be talking about, shortly after that, we're going to be talking about the difference between life insurance and stocks. So make sure that you stay tuned to that. But let's play fact over fiction. Insurance is a waste if I never use it. That is fiction. Insurance is about protecting your future from the unexpected. It's peace of mind. And a lot of people come to find that peace of mind is not enough for them to invest in until they need it. But if you need it, it's too late. It's not just a payout like renter's insurance. Renters do not make it mandatory for you to have renter's insurance. Truth be told, you could put it in the contract that it's mandatory. You could charge extra for the rent and lock them into a renter's insurance contract where they're mandatorily paying the renter's insurance when they're paying you to rent. That way, if they leave, then you can take a claim out on the insurance policy and renovate the whole property. And if you're a landlord, this covers you and your assets and keeps your property in better quality and better condition. If it's not a mandatory situation, then by contract, then they're not legally required to have that renter's insurance, and it's their loss, your loss, versus you taking it out on them in civil action, trying to recoup the losses if they've moved out and they don't actually have equity to pay towards the damages done to the property. That's a thing. Now, this is good stuff. All insurance policies are basically the same, also fiction. Coverage, exclusions, and costs vary widely. Reading the details matter. You must always read the fine print all the way down to the hieroglyphics because it means something. If it didn't mean anything, it wouldn't be written on the paper. I'm too young or healthy for life or health insurance. Again, Kobe was old. His baby was a newborn. Both didn't make it out that plane crash. You are never too young to have life insurance, and you're never too healthy to not have health insurance. Now, you might not be able to afford health insurance, and you might allow your health to get bad longer over a period of time to save money on medical expenses. But if you had the money to afford the health insurance, you would probably aim towards better health and pay more visits to the doctor. So it is fiction. The younger and healthier you are, the lower your premiums, locking in savings for years to come. Because if you are at your healthiest, they will charge you the lowest premiums. The older you get, the higher the premiums get. The worse your health gets, the higher the premiums get. Ultimately, the goal is for the insurer is to have you cover the full cost of the policy before a payout occurs, so that worst case scenario, they're just giving you your money back. In the luck of the draw, where you paid less than what they're giving you, you turn a profit off of the policy. And that's what most people want to experience as a consumer, is taking out insurance and getting more back from the insurance policy than what they paid into the policy. But it is not the case, because every system you have to put into the system to get out of the system. And if everybody is getting more out of the system than what they're putting into the system will run barren. So you're typically supposed to get a percentage out of the system in comparison to what you put into the system, so that the system can operate and still have resources left over for the next time that even you yourself want to tap into the same system. But let's talk about how to pick the right policy in 2025. So let's get practical now. Here's what you need to know with the latest 2025 data. Health insurance has the average silver tier marketplace plan being around $483 per month in 2025, but costs vary by deductibles, $2,000 to $8,000 deductibles, and the coverage tiers. So assess your needs. Now, remember, a deductible means that you must pay this amount first before they cash out on your claim. So if you have an $8,000 deductible, that means that you're paying up to $8,000 before they start paying on your claim. It makes sense when you don't need the policy based on your decision making. It don't make sense when you're not sitting on $8,000 and now you have to take out a claim. And the claim might be less than $8,000. Do you have chronic conditions or need regular medication, or just want that peace of mind? You have to ask yourself that. The best plan for you isn't always the cheapest plan. It's the one that fits your health profile and your budget at the same time. In auto insurance, the full coverage policies average around $2,313 per year in 2024. And that's going to be individuals with no crash history. That's going to be individuals over the age of 30 and probably male, because they charge females more money than they charge men, and they charge young adults of both male and female status cheaper than adults over the age of 30. So with a projected 5% increase in 2025, bundling home and auto can save you 15 to 25%, offsetting that 5% increase, which gives you an ultimate 10 to 20% deduction if you bundle home and auto. Now, that I've looked at some home auto bundles, and depending on the policy that you get, they might quote you more than an insurance company that just insures your house by itself. So you really want to check the difference between bundling your home and auto with having a separate home and auto policy. You want to avoid overpayment, because did you know 23% of policyholders are overinsured on collision but underinsured on liability? What does that mean? Liability is going to be more towards the personal medical health. The collision is going to be more on the property damage. Everybody's concerned about hitting that Porsche. Everybody's concerned about running into that wall, but not very many people are concerned about the medical expenses for the number of passengers in the vehicle, because when you get into an insurance claim, the medical bills of your vehicle will cover you as a driver, guaranteed, and then every other person that was inside of your vehicle during the crash. Even if it's friends or family, they are now your enemy because their lawyers will cash out on your crash. Now, millennials are overpaying by $600 a year on average by not shopping around and around about the renewal time. So they could see themselves spending $600 more than what they need to. I just told y'all yesterday how my homeboy was paying like $2,500 in a month because he was behind on his payments, and then he had to renew, and his homeboy was on his policy, and his homeboy cost him $500 out of his $800 policy. And I was like, whoa, that's a lot of money. Shoo, my car cost me $100 a month. $97, right? His car was like $250 or something like that. The other guy was like $5 something. I was like, oh, and then they're splitting it down the middle. Nah, sir, I'll pay you the value of my car. That's about it. But here's a pro tip now. If you use this comparison checklist when evaluating insurance policies, you'll see yourself with a lot less financial expenses. Start with deductibles. Make sure your emergency funds can cover the maximum out-of-pocket costs. If you're throwing up high deductibles just to get a lower policy rate, you understand that your insurance policy is probably not going to cover the crash because you don't have the money to cover the deductible. And if the crash costs less than the deductible, there's no point in the policy covering the crash because you're going to cover the deductible, which is the cost of the crash. So they'll just reimburse you the difference once you've covered the deductible. You want to deal with some network restrictions because some policies do not have the appropriate network that you can access. Check if your preferred doctors or hospitals are in the network that you're using when you're dealing with health insurance. Check with your network for your car insurance to see if the mechanics and service providers for your vehicle are covered under that network. You know, all of these things are equally important. Body and fender repair, you want to make sure that they're also covered in a network to make sure that when you take out a claim, that claim can cover everything you're about to get done. Yes, when you take out take out a claim, your policy will increase after the claim pays out. But you can actually take out a claim on vehicle repair if it is a non-collision repair and you have comprehensive damage. You could take out an insurance claim and rebuild your motor. So you got water in your engine. You didn't crash into anybody. The engine's broke. It needs to be repaired. You can take out an insurance claim. It'll pay your mechanic the $8,000 that it costs to repair your engine, and you get the insurance claim. No PIP or anything like that, just straight claim. Now, yeah, every time you take out a claim, that's a strike against your policy. They only allow you to do 2 claims inside of a term, and then on the 3rd claim, they cancel you. So if you take out a claim to do vehicle repair, you only got 1 good claim left inside of the 6-month term, and then after that, you got to wait until the policy rolls over before you take another claim. Discount eligibility, you want to be able to ask the person that you're talking to about new telematics, which is driving behavior or loyalty discounts. A lot of places offer Right? So they offer the ECM thing where you plug it into the car, or you download an app on your cell phone, and it gauges the movement of the vehicle, gauges the movement of the cell phone, and based on driving habits, it'll determine whether or not you have been driving optimally. And if they determine that you've been driving optimally, then you'll qualify for higher insurance deductions, which is something that you could really use and lock in. So let's play what if. Imagine you took your insurance budget and invested it instead. Here's what the numbers say. The S&P 500 delivered 14.32% annual returns between 2020 and 2025, or 9.62% after inflation. Insurance costs have raised about 12.8% after inflation in the same period, now eating up about 7 to 10% of the median household income. So if you invested $300 a month instead of spending it on premiums, you'd have about $23,000 in 5 years at 14.32% return versus $18,000 spent on premiums. Now, the difference is how much of that money would have went towards doctor visits, medication, surgeries, all the stuff. You got to think about the pros and cons about it. Every $1,000 per year saved on insurance could grow to $46,000 in 30 years at 7% returns. But here's the catch. Insurance doesn't pay like investments, but it protects your wealth from catastrophic losses. The real win is balancing both. Keep essential coverage, optimize your policies, and invest your savings for long-term growth. If you, like I told you guys before about putting up trusts all over the place, if y'all had a trust in each one of your last relationships, and in that trust, you had an insurance policy on your ex that was covered by the trust, and then you got the difference. All your ex got to do is pass over, and you get a big check that goes to that trust. And then since the 40% is divided between the two beneficiaries listed on the trust, if one of the beneficiaries pass, then the insurance policy goes to the trust, and the remaining beneficiary gets the full 40% difference, where 60% is reinvested back into the trust. So if you have 5 relationships over the course of 20 years, you should have 5 life insurance policies paying out from 5 different trusts that should still be paying you out $3,000 to $5,000 a month per trust, which is almost like 15 grand a month. And all you need is to get that phone call that one of your exes passed away. And then whether that was $100,000 policy or $1 million policy, that's a lump of cash that goes into a trust that's now going to pay you an increase because you get 40% of whatever went into that trust. Think about it now. So here's another question though. Is a life insurance policy better than investing in savings and stocks? Well, the answer depends on your financial goals, risk tolerance, and what you want to leave behind for your loved ones. So let's break it down. The details with facts, statistics, and a direct comparison between being a life insurance beneficiary and a stock market dividend receiver. When we're dealing with life insurance policies versus stock market investments, the return and growth potential of the stock market with the S&P 500 has an average of about 10% annual return over the long term, though this is reduced by 2 to 3% of inflation, which is going to give you approximately 7% annual return. But returns can be volatile from year to year. Investing in a stock is best for long-term wealth building with the potential for significant growth and the ability to access your gains during your lifetime. A whole life insurance policy has the average annual rate of return on the cash value component is about 1 to 3.5%, with some policies projecting up to 4%. The growth is steady and predictable, but much lower than the typical stock market return. Payouts and beneficiary experiences are going to be a little bit different, because life insurance beneficiaries, upon the policyholder's death, the beneficiaries receive a tax-free lump sum payout outside of probate tax. They call the death tax, where the death benefit is paid to the beneficiary, often within weeks of passing of the deceased, excluding any concerns for foul play and non-natural causes. For example, a $500,000 policy pays out the full amount regardless of market conditions, providing immediate financial security and liquidity. Stock market dividend receivers have stock dividends that are periodic payments based on a company's profits, usually yielding 1 to 3% annually. Upon the investor's death, heirs inherit the investment's market value, but this can fluctuate and may be subject to capital gains tax and probate delays. Now, when we start recognizing the risks and predictability of this, life insurance is going to offer guaranteed stable returns and a predictable payout, while the death benefits are unaffected by market downturns, such as the one that we had in April, making it a low risk option for protecting your family. Stocks are high risk due to the market volatility. While the long-term trend is upward, values can drop sharply in the sharp turn, potentially reducing the inheritance after you pass, before the beneficiary has the opportunity to obtain them. This is just like what we were talking before about how Wednesday Orchid Island was at like 720, and then Thursday Orchid Island was at like 689 or 688. And if I would have waited 24 hours to invest, I would have gained $22 on the quantity of shares that I would have bought. But because I bought it the day that I bought it, I only turn a profit on the sale if the stock raises, because it was a dip of like 22 cents per share. And if the stock would raise 22 or 25%, or 22 to 25 cents, 28 cents per share, if it raises that between now and the sell date on the 1st, we would see somewhat of a return, even if it's just pennies, but we still get the full cash out of the dividends that are supposed to be qualified for on the 30th of the month. So these are the short-term volatility downturns that negatively impacts a beneficiary's ability to collect. When it comes to tax treatments, life insurance policies have a death benefit that are reasonably tax-free for beneficiaries up to a certain amount, where the cash value grows tax deferred, and policy loans can be taken out without triggering taxes. Now, this is where the wealthy run off with the money, because they will take capital, put it into the insurance policy, building up the equity of the insurance policy, take out a cash loan against the insurance policy, buy whatever it is that they want to buy. And now the monthly premiums that they're paying is to reimburse the insurance policy on a loan. Again, if you're utilizing stock options to pay for that particular type of scenario, then the profits from the stock is offsetting the loan, which means that you didn't make a profit, but you still got something that you did not ultimately have to put extra money on. Now, stock investments gains may be subject to capital gains tax when sold or inherited, depending on the account type and the timing. So here's a list comparing whole life insurance cash value growth and S&P investment returns over a 30-year. And we're going to put this along with the guaranteed death benefit from the life insurance policies within the same period of time. After 5 years, a whole life insurance policy at 4% could likely put you out a $27,082 return. S&P 500 would put out an investment of 7% return, which is about $28,754, which is a little bit more. Life insurance death benefit of $500,000 after 10 years with a whole life insurance policy, you would be looking at 4% return on $60,918. Or if you put S&P 500 investment into the same location, you're looking at a 7% return at $71,152. Now, this is not from the dividend rotation strategy that we were talking about, where you would have been getting 168%. So if you're looking at a $60,000 investment, you're looking at potentially seeing something close to $100,000 or $90,000 worth of return, because it would be giving you 168%. Now, a life insurance death benefit policy of $500,000 after 15 years has a whole life insurance policy of 4% return, where if the person dies within that 15 years, that you get a $500,000 on top of this. But the value that you have, the equity that you have in the insurance policy would be $101,722, which is enough to buy you a BMW after 15 years. Remember, I told y'all before, set up your 10 and 20 year life plans. The S&P 500, if you would have invested with 7% return, you would have had $130,000. And this is based off of the minimum monthly payments for an insurance premium. This isn't the type of $1,000 investments that we were talking about doing a couple of weeks ago, but you still would have gotten $130,106 off of that. Now, a life insurance death benefit policy of $500,000 after 20 years, you would have had, with that same 4%, $151,259 versus the S&P investment of 7% return with a $220,743. And that just blows my mind, because I've sat there and went over a way where you could potentially get between 21 and 170%, which would double your money every year and likely put you at $1 million within 10 years. And this is a 20-year plan that puts $250,000 in your pocket in 20 years. But best case scenario, if you croak, there's an extra 500 grand in there. Same benefit policy after 25 years. 4%, looking at $211,362. S&P 500, same invested amount at 7% return, $329,316, which is like 100 grand more, $110,000 more. And if you rode this wave for 30 years for some unknown reason and survived it, at 4%, you're looking at $284,497 for a life insurance policy, but you would be getting, for S&P 500 investments, you would be getting almost $500,000. It would be at 7% return, $493,482, which is essentially $7,000 less than the payout of the insurance policy. You would have earned that in stocks by investing it over 30 years and just not dying, which almost makes not getting health insurance a thing. But there is a benefit there to it. Now, I want you guys to understand that the company highlights that the comparison highlights that we had that were with the S&P 500 historically offer higher returns, but only the life insurance policy guarantees a substantial tax-free death benefit. And that's the only difference, because when you're looking at how much more you're getting from the S&P 500 and you're looking at almost 23% taxation on that, you're probably going to be making close to the asking price for the beneficiaries, regardless of the market performance. But if the policyholder dies early, the life insurance beneficiary receives the $500,000 tax-free regardless of how much has been paid in premiums or market performance. And that's what people get the health insurance for, to roll the dice. If you're getting a health insurance policy for somebody who's guaranteedly not going to live to the end of the policy term, yeah, they might charge you a little bit more, but if you can afford to pay that payment, when that person kicks the bucket, guess what you get? Now, if the investor lives and invests in stocks, the investment could be worth nearly $500,000 after 30 years, but this is not guaranteed and depends on market conditions. So the key takeaway is that life insurance is better for those seeking guaranteed tax-free protection for those family members that they care about, especially if the primary concern is providing for dependents after death or covering estate taxes quickly. Now, stock investments are better for those seeking higher long-term returns, gathering liquidity, and the ability to access or grow wealth during their life, but come with higher risks and potential tax implications. Combining both, if often recommended, use life insurance for security and estate planning, and stocks for wealth accumulation and income during the life. Life insurance is going to provide certainty and immediate protection for beneficiaries, while stocks offer higher potential returns and lifetime income for the investor. The best choice depends on your personal financial goals, family needs, and risk tolerance. So here's a detailed comparison of monthly payments for life insurance policies versus investments in the same amount in a stock market portfolio using the current 2025 data. For a $500,000 policy, this is going to be aged and gendered in 2025, including individuals that are of the age of 69, because some policyholders don't allow new applicants after the age of 69. At age 30, for that $500,000 policy, you're looking at approximately, on average, around $359 per month for the guy, $330 per month for the girl. At 40, you're looking at $532 for the guy, $488 for the girl. At 50, you're looking at $1,014 for the guy, $911 for the girl. And at 69 years old, you're looking at $1,900 a month for the guy and $1,600 a month for the girl. If you can't afford that, you probably should take whatever you can and put it into the stock option, because those are monthly premiums, not annual coverage. Premiums are approximate and may vary by health, insurer, and state, so it might be lower, but if you have poor health, it might be higher. Rates for ages 69 or older are based on the current 2025 data for standard applications. Term life insurance for 30-year-olds for $500,000 for 20 years typically are going to be allowing $25 to $31 a month for women and $29 a month for men, where investments equivalent to the monthly premiums in a S&P 500 index fund would be a whole lot different and a lot more beneficial. Check this out. See, I got to sip on the scissor. Assume you invest the same monthly amount as the insurance premium into the stock market index fund, averaging approximately 7% annual return after inflation. If $359 a month for the 30-year-old whole life insurance was invested for 30 years, your future value would be $437,000. And at $320 a month for the women, your future investment would be $402,000. And that is for a 30-year-old trying to invest into a, I believe, a 20-year plan. Now, you're looking at $25 a month for the 30-year-old female investing for 30 years. That's going to be $30,000. And this is going to be for the term life insurance policies, the $29 a month for the man, for a 30-year-old man, for 30 years of investment. So he's 60 at this point. There's $35,400. So term life insurance is actually a more beneficial thing to do if the person stops before the term is up. It's a roll of the dice. It's a higher risk gamble. So calculations are used based on the standard future value formula for monthly investments at that specific 7% annual return. So that is not the exact value that they're going to be giving you, but that is a reasonable approximation based off of the information that we've been able to find so far today. Now, what do beneficiaries receive? With a life insurance policy, beneficiaries receive guaranteed tax-free lump sum, even if it's a $500,000 policy, upon the policyholder's death, regardless of when the death occurs within the policy of the period. Now, after any waiting period occurs, that's when you're getting your payout. But if you croak before the policy or after the policy expires or before the policy is renewed or whatever the case may be, you can't take out the claim. Investment heir portfolio. If you inherit the market value of the portfolio at the time of the investor's death, this amount can be higher or lower than the insurance death benefit depending on the market performance and the time invested. Inheritance may be subject to capital gains tax and probate depending upon the amounts and values that's being utilized. Now, the key takeaway here is that the whole life insurance guarantees that fixed payout for beneficiaries, but monthly premiums are much higher than term life or investing. The stock market if you're throwing almost $1,100 a month into the stock market, you're throwing between $12,000 and $15,000 a month into the stock market. You're going to see a larger profit if you don't die by the time this is over. And you would be able to change your standard of living. You'd be able to live your best life until you croak while getting to that level, which for some of us is a lot more progress. I still believe that you should put some money aside and try to get yourself an insurance claim, insurance policy, but it depends on you and it depends on your circumstances and your income and the amount of money you wanted to invest in the stocks to begin with. Stock market investing offers higher potential, long-term returns, but no guaranteed payout at a specific time. And the values can fluctuate. Term life insurance is the most cost-effective per protection. You will be able to get pretty decent coverage for that, freeing up more money to invest for wealth building. Because, as soon as somebody dies, you've got a larger stack of cash that you can reinvest into utilizing more returns. Now, for immediate tax-free protection, you have that life insurance that is a superior protection. For long-term wealth accumulation, investing in stocks generally outperforms whole life insurance on a dollar-for-dollar basis over decades, but with more risks, because you can put a lot more money into your insurance policy, borrow against the policy, and then do something with the money. And as you're paying on a policy, that's called a tax blanket. So it is a benefit, even if it's not dropping you a bunch of cash in the short term. Choosing between these options depends on your goals, security for your family, and long-term growth, or a blend of both. So let's make this interactive. What's your biggest insurance headache? Drop that in the chat, or if you guys want to tell me about it on the show, make sure y'all click the link or request that link if you don't see the link, and we can talk about it. Would you rather save $500 a year on insurance or invest that $500 for 30 years? Let's see what your answers are. Me, myself, with the dividend rotation strategy, I probably reinvest that bad boy and then to just sit on it. Now, has insurance ever saved your day? Or have you learned a lesson the hard way and then decided to go get insurance? For example, individuals who didn't get that insurance on their rental car, and then the rental car got into an accident. Now they had to pay to fix it. That situation where an individual didn't get the insurance on a computer or an electronic device that they had bought, and then the device broke, and then they had to go buy another one because the company wouldn't replace it, and it was outside of the 1-year warranty package. They have a manufacturing warranty with most items. You got to think about that. Insurance is for peace of mind, but it works for those people who are seemingly accident prone, where nothing ever goes the way they would expect it to go, and something always breaks, and people always get hurt, and there's always a random surprise financially that negatively impacts your ability to succeed. Final thoughts: taking a few minutes each year to review your insurance can literally save you thousands, which could safeguard your family's future and allow you to have more money to pay towards those insurance premiums. You don't have to get a $500,000 insurance premium. You could get $100,000 insurance premium. $100,000 will help you buy a house. You know, you don't got to go for the long haul. You could go for a little bit, because a little bit is a little something here and there, you know. And it's one of the smartest financial habits that you guys can adapt. You can adopt that and adapt to it. I want to thank you guys for joining us. Don't forget to subscribe. I want you guys to tune in for tomorrow's show. We've got the members only show that's going to be coming up tomorrow. Monday, we're going to be talking about the dome and how that's going to impact us. We should be doing a top 5 insurance mistakes that you're making right now as a follow-up to today's show, but I'm not sure when we're going to air that. It should be in the next week or so. So if you want to get more information about insurance and what you should and should not do with your insurance, make sure that you hit the notification on the upcoming shows so that you can be updated on this show. Until then, you know, here's a smarter, safer living idea. If you want to personalize your checklist or want to be featured on our next episode, make sure you let me know about that as well. But the checklist that we have is to determine what coverage do you need, what coverage are you using, and are you getting the best deal for it? What discounts do they have available? Compare prices with competitors to make sure that you're getting the best deal, and sometimes change if you have to. Now, make sure that you guys let us know in the comment sections or send us a message after the show if you guys want to be in the next show when we're talking about some of the other things that we've got going on. But you guys always know that here on This and That, where we talk about this, that, and everything in between, that you are all inclusive from Twitch, Twitter, and YouTube, that we can squeeze you guys in at any point in time during the show. Just let us know. Long as it's appropriate, we got you. With that being said, that's ironically all I got for you guys today. I thought this was going to be a 2-hour thing with all 75 pages of information, but I was like, you know what? I think we probably, depending on how fast we talk, we might be able to cover a lot of information. But since that's all I got for you guys for today, ladies, I want to say, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So ladies, please make it make sense. And fellas, as I said before, this is 75% male-driven podcast from a male's perspective, but there's at least 25% of females that's coming and learning how to be higher value women alongside us trying to be higher value men. Understand, the information that I provide you is not gender exclusive. Ladies can come to the show and learn how to make, save, and invest money better than men do, and they are not distracted by men because men spend their money on women. So ladies can make themselves millionaires using a 10-year course track, using a 20-year plan, where men will still be clubbing trying to find that wife by the end of it. So you've got to make sure that you're prioritizing what is best for you. You got to make sure that you are putting your ambitions, your goals, and your desires first, and then also locking in any future expectations that you hope to achieve. Whether you're looking for a long-term family, whether you're looking for trips around the world, whether you're looking for living in another country, whatever your goals and ambitions are, you need to be able to stick to those goals, stick to your budgeting plan, stick to your investment strategy. And if you have anybody of value that you want to leave all of this stuff to, you could throw all this stuff into a trust, make the trust a beneficiary of the life insurance policy, have the trust pay out. That way your trust can pay your kids, your grandkids, your girlfriend, your ex-girlfriend, your wife, your ex-girlfriend and your wife, and in different increments, however you want to do this, man. And you can set it up where they don't have to deal with probate because all of your assets belong to the trust and your assets will be divided as the trust dictates, especially when you're passing over, turns a revocable trust into a non-revocable trust where nobody can change what you did after you pass, which means that whatever people are supposed to get, that's what they're going to get. So you can spend 75% of your life building a legacy and 15% of your life enjoying that legacy. Or you could spend more time enjoying life, not having a legacy and not caring what is left behind for those who come after you. But for anybody who wants to be first generation generational wealth, anybody who wants to build more success so that they can have more success to give to their children and their children's children, then we all got to come together on this and that, where we talk about this, that, and everything in between. And we talk about all the ways that we can make, save, and invest money, all the ways that we can save money on spending, increase our spending power, stretch our dollar a little bit further, and come to determine exactly how much more we have in comparison to what we need. That way we can take what we don't need and turn a profit off of it, which the key goal in the strategies that I'm giving to you is either retirement or early retirement. Because if you can make more money than what you need, then you don't need to work anymore, because the money that you need to survive is coming to you on a regular basis. And if you have more money coming to you than what you need, you could take what you don't need and reinvest it, which increases the principal, which means next time you're getting more. If the hardest part of your day is waking up at some point in the middle of the evening time and rotating your stock options before dinner, I think that is a very good stressful day, is if you're literally only moving 10 or 20 or 30 stock options over the next hour while you're waiting on dinner to be ready, so that you can then have dinner, where the other 23 hours out of the day you're enjoying life with your friends and family and children and grandchildren. I think that is the best life to have. Literally, we know people who are broke with no future in mind that spend more time playing video games. If you spent 1 hour moving your money around so that you had another 10,000 coming in next month, I think that is a better strategy of life than just hoping that it's going to work itself out and that Social Security is going to get better. Because as you've seen, Donald Trump is taking away from Elon Musk is shaving costs from everything that is not efficient. And giving money away to the American public is not efficient. So any programs that are unnecessarily or unjustifiably providing capital to the general population, they will be halted coming soon, which means free money is not going to be a thing anymore, and you will have to earn it at every age. So get ready, because Walmart is going to be hiring all y'all 65 and older individuals to be door greeters, because that's what the hell you're going to have to do to make your money. Be the janitor sweeping the parking lot outside the McDonald's, the Wendy's, and the Checkers. You're going to be the guy greeting people at the auto mechanic shop. I'm telling you, y'all gonna have to work, because if y'all don't build the nest egg now, your 20-year plan should make you a millionaire inside of 20 years, which is easier than making yourself a millionaire inside of 10. You got to put a lot more money away to live that life in 10 years. But if you don't have a 5-year, 10-year, 20-year plan, you're already off to a bad start. Because I started talking to you guys about setting up that 20-year plan about 9 months ago. So if y'all ain't started over the past 3 months, y'all need to start today. Make sure that y'all stay tuned, because we're going to be giving you updates on our dividend rotation, because in real time, we are following the dividend rotation method that we told you guys about a few weeks ago. Go back and look at the show, type in dividend rotation, and it'll on the channel, on the YouTube channel, and it will show you the dividend rotation method, how to do it, which stocks that we gave you a list of stocks. If you watch that show, we gave you a list of stocks in real time in 2025 that will work for the rest of the year to rotate out and get 100 to 165% return on your investment. This is not a seminar that's asking you to give me cash. While I would love for you to throw some money at the channel, while I would love for you to join a membership, that is not what we're telling you to do. We are telling you specifically, take the advice that we gave you, do some research on it, see if you can make you some extra money. And if you do, come back and let us know. Because I know I just made a shit ton of money off of the trades that I told y'all about. So if y'all follow my lead as I build myself up, y'all are building yourselves up too. So when I'm touching $1 million off of the advice that I've given you, you should be touching $1 million too. If you're not, you're doing something wrong. There is no way that you and I had this conversation together and I made it to be a millionaire and you did not. It's not possible, because we're doing trade. We should be doing trades on the same day. We should be buying into the same stuff. We should be selling the same stuff around about the same day. And if we're doing the same thing for 5, 10, 20 years, we should have the same. The only thing that's not going to be the same is how much money we started with and how much money we kept in there. That's going to be the only difference. But if you're not taking my advice and you're not using this for your own benefit, here on This and That, we're working for the benefit of everybody. We want to see higher value men. We want to see higher value women. We want to see better relationships. And that's what Thursday, Friday, and Saturday is about. Better relationships, better communication. But you improving your family life requires you to improve your income, and improving your business life requires you to stabilize your family life. It's hand in hand. And on this show, we talk about both throughout the week, what all we can do. And that's why we talked about health insurance today, because if you navigate through this and navigate through the other things that we talk to you guys about, you will have less stress every day. And that gives you more peace, and more peace gives you more rest, and more rest gives you a clearer mentality that aids you in your ability to make informed decisions, which allows you to make the best decision for the sake of yourself and your team and your family, your network, your pack, the people that are working with you. That way, nobody's objecting to the decisions that you're making, because your decision is going to benefit everybody in the group. With that being said, that's all I got for you guys today. Thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. Any comments that you guys give us as the show wraps itself up will be in the comment section at the top of the screen. Thank you guys again, and I will see you guys tomorrow night.
Higher ground. Used to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds, raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground, where excellence is found. My potential knows no bounds, raising the bar, breaking ground.